Thanks for clicking. Canada's interest rates might not have to stay as high for as long as many have predicted. This was the message coming from former Bank of Canada Governor Stephen Poloz in an interview with Better Dwelling. Poloz's interview comes as a growing number of commentators are saying that the central banks, the Bank of Canada, the US Fed, should pause on their path of interest rate hikes and see what effects those interest rates are having on the inflation rate and on the economy.
Just stop it.
But Poloz says that the slowing of the economy is not just a matter of raising or lowering interest rates, and that there are a number of factors to consider that a lot of the commentators are missing. So what I want to do today is go over Poloz's interview, take a look at what the former Bank of Canada governor says the majority of commentators are missing, and then discuss what to look for next. It is the first of the month, so we're expecting to get October's real estate data out from the local boards any day now, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. Former Governor Poloz begins his interview by stressing the importance of forward-looking indicators, saying that we can't just look at today's inflation rate as it tells us nothing about what will happen in the future.
If you look into the rearview mirror, you're going to drive through the intersection every time, right? You're not going to stop in time.
So what Poloz is saying is that the current inflation rate, right now at 6.9%, tells us nothing about current monetary policy. It tells us the effects of monetary policy from 18 months ago, which was still basically at zero. So Poloz says we need to be using forward-looking indicators when judging where the economy is heading, where the inflation rate is going to be in 18 months from now.
So we don't know exactly how much work has to be done, but I do want to mention a couple of things that people aren't really talking about.
First, interest rate sensitivity. We've talked before on this channel about how in previous bouts of higher inflation, interest rates had to go much higher than they are now to get an inflation rate under control that is much lower than it is now. Poloz says that that's no longer the case, as Canadians have taken on relatively much more debt than they had in previous bouts of inflation. Much lower interest rates are needed in order to get them to slow down the spending.
Interest rate sensitivity of the economy is probably higher today than it was in previous episodes like this, because there's more debt and everything.
And that point, I think, is well taken. In 1980, the ratio of household debt to personal disposable income was 60%, and now we stand around 180%. Since our debts are so much higher, since our home prices are so much higher, Poloz is saying that any marginal increase in interest rates will take a lot more money out of the economy in 2022 than it did in 1980, 1981. And as such, we won't need to have those 20% interest rates that we saw in the early 1980s to take the same amount of relative money out of the economy. And obviously this isn't anything to celebrate. What Poloz is saying is that the Bank of Canada can tip the Canadian economy over much quicker, much easier than they could in the 1980s. And that's always been one of the main worries as the bank underwent this interest rate hiking cycle. If they do tip the economy over and the inflation rate is still at 8%, will they reverse course? What will they do?
Well, I should probably scoot.
So Poloz says that due to higher debt loads, the Bank of Canada can take out much more money from the economy than they could before with relatively smaller interest rates. But he also says that higher gas and food prices are also taking a significant amount of money out of the economy.
The second thing is that commodities are high, so like things like oil, gas, gasoline, fertilizer, things that are ingredients and everything going in the economy. And that's why we have as much food inflation as we're seeing. Well, food and energy for your car or your house, that's costing more. And that means there's less money for all the other things you're thinking about buying.
So because food and gas prices are up so much, Canadians are spending less money at Walmart, which should in turn put downward pressure on the inflation rate. Poloz then says that the extra money being taken out of the economy vis-a-vis gas and food prices is equal to about 100 basis points in interest rate hikes.
So what that does is that slows down the whole economy way faster than interest rates do. And this effect is not really being talked about. And I think it's worth maybe 100 basis points worth of interest rates in terms of how its effect is.
So while Poloz is arguing that higher food and gas prices will take money out of the economy fairly quickly, history shows us that that's not exactly the case. When we look at the high inflation, the great inflation of the late 1970s, early 1980s, it's largely attributed to higher gas prices and higher food prices. As the price of gas, the price of energy goes higher, as the price of food goes higher, so too do workers demand higher wages, and higher wages equals higher inflation. So it's not clear that money being shifted towards higher gas prices and higher food prices is going to help to calm down the inflation rate. So I could be wrong, but I don't buy the argument that higher gas and food prices are actually going to be good for the inflation rate, that is going to make it so we don't have to have higher interest rates for longer. And the third factor, ensuring interest rates won't have to stay as high for as long, is quantitative tightening. The Bank of Canada pulling money out of the economy vis-a-vis the selling of Canadian government bonds.
The other thing that people aren't talking about is quantitative tightening. So all the central banks are doing that. And that was powerful when it was quantitative easing. Why wouldn't it be powerful when it's the other way around?
Now, Poloz only spends about 10 seconds talking about quantitative tightening, QT, but very basically, during quantitative easing, the Bank of Canada bought up hundreds of billions of dollars of bonds from the Canadian government, from the banks, but from the Canadian government, and now they are selling off those bonds. And every time they sell those bonds, people have to buy those bonds. So when they buy those bonds, that money is leaving the Canadian economy and going to the Bank of Canada. And if we look, as of right now, the bank has sold off about 15 to 20% of its bonds since this point in time last year. So in summary, the higher debt loads being held by Canadians, higher food and gas prices, and quantitative tightening, these three factors, Poloz says, will ensure the Bank of Canada doesn't have to keep interest rates as high for as long to get the inflation rate back under control.
All these things suggest that interest rates may not have to go up as high or stay high as long as the market seems to think.
But Poloz then admits that nobody really knows anything.
Literally, we honestly don't know. No one really knows. It was a unique situation.
I know about things.
So if the Bank of Canada isn't going to have to keep rates as high for as long, then when can we expect them to, at minimum, pause, and when can we expect them to lower interest rates? Poloz says that it can take about a year from this beginning of interest rate hikes for the housing market to bottom, and then probably a year after that until we see some unemployment, until we start to see some real damage done to the economy. And it's that point at which the Bank of Canada can reverse.
Say, interest rates have been rising now for like 6 or 7 months. So we got at least a year from now before we really have the full effects. And
so in summary, Poloz says that we need to keep an eye on current trends to see where the inflation rate is heading, to see where the economy is heading in 12, 18 months from now. That the inflation rate that we see right now doesn't tell us anything about monetary policy right now. It tells us about monetary policy from 12, 18 months ago, which obviously the Bank of Canada, the central banks, have in retrospect said was too loose. I think Poloz's argument that the Bank of Canada can cause a lot more damage to the economy with much lower interest rates than they could before is definitely a prudent one, although not a very comforting one. The argument that high food prices, higher energy prices will take money away from other parts of the economy, I think is suspect and isn't borne out when we take a look at history. In fact, those higher food, those higher gas prices tend to feed into other parts of the economy, into wage demands, etc., which only push inflation up further. We saw this in the 70s and we saw this in the early 1980s as well. QT, quantitative tightening, is pulling more money out of the economy. That much is clear, although at a very slow pace, like we said, only 15 to 20% since this point in time last year. So we do have other factors other than higher interest rates pushing down our inflation rate here in Canada. But whether or not they will be enough to get our inflation rate back down to that 2 to 3% level by 2023, 2024 remains to be seen. We will continue to track the Bank of Canada's interest rate policy as well as our inflation rate on this channel. Click like and subscribe to get those updates, but for now, thanks so much for watching.